So I have pasted the example here. Just pause the video, solve it by yourself, and compare the answer. So here is the answer, right? And then the same example we are using with unit of production method. Also solve it and compare the answer. Here is the answer, right? If you have any question, please do ask me in our WeChat group or post it on Blackboard discussion forum. And here is use double declining method. Here is the answer. Okay, so other issues in uh, finding out the depreciation. Number one, the plant assets are more complex. They have long lives. What if the life has increased? We estimated that it's going to be used for 5 years, but after having major repairment, the life is increased, right? So depreciation effect income taxes we just discussed in our previous slides, and also gain or losses when the plant assets are sold. We hope that it will be sold after 5 years 1000, turned out to be it is sold only for $100, or it is sold for 1500. Then how are we going to treat that one, right? And what happen if we change the accounting in future, accounting standards or accounting or methods for depreciation in future, right? Then all these issues also impact our depreciation expense and also profit as well. So we have successfully completed the required learning objective for our plant assets. So basically we have also covered our asset side of the balance sheet. So if we just find out the where is the assets, we discuss cash, we discuss cash and cash equivalents, we talk about market securities, we talk about the accounts receivable, and then we talk about inventory, and then we finish the long-lived assets or the fixed assets, right? And on the right hand side we have liabilities and honor equity. So first one is liabilities. So let's talk about how we're going to treat liabilities in accounting system. So next chapter going to be on liabilities. So our first learning objective is accounting for current and contingent liabilities. So there are two types of liabilities: current liabilities and long-term liabilities, right? So first we cover in this lecture current liabilities, and in the next lecture we talk about long-term liabilities and honor equity chapter, right? That's going to be our last two lectures. Okay, so how are we going to account for contingent liability or current liabilities? Number one is current liabilities. So that liability that you have to pay within 1 year or its operating cycle. So there are two kinds of liabilities. One is called liabilities, current liabilities with known amount, and current liabilities with estimated amount. So let's talk about that. The current liabilities with known amounts, they are called account payable. How much you have to pay to the supplier, how much have to pay in terms of notes payable, how much you have to pay for tax. Accrued liabilities, payrolls, which means the wages, salaries, unearned revenue, and current portion of long-term debt, right? Let's talk about the current liabilities of known amounts. Number one is accounts payable. We already know that. and we discussed it in numerous time in our journal, making journal, ledger, and liability stuff as well. So the treatment of accounts payable is the same when you purchase raw material on account, then the entry would be inventory to accounts payable. For example, 10,000 to 10,000, right? Treatment we already know, just here, it's a refresher, and it's a common transaction in credit purchase of the inventory. One is the short-term notes payable, which is the liability that you write in the form of notes, and it is for less than 1 year, which is used to borrow cash or purchase assets. The company must accrue interest expense and interest payable at the end of the period, right? How are we going to treat the short-term notes payable? What are the treatment in accounting here? So I have pasted an illustration. I just want you to pause the video and then solve by yourself and match the answer accordingly. Okay, let's do this. We have 8,000, we purchase inventory, and we write against it a short-term notes payable with 10% interest rate. So when we purchase the notes payable, what is the entry? The inventory to notes payable, right? Answer is 8,000. So when you pay back, so the fiscal year ends each September 30. So at the year end, the company must accrue interest rate at 10% for January through September. So see here, you purchased in January and there is like a 9 months here. But this 10% is written as annual basis. So how are we going to treat that one expense? The expense is going to be 600. How it is calculated? So 8,000 multiplied by 10%, 800. That is on yearly basis. We divide by 12, multiply by 9 months. Answer is 600. So interest expense to interest payable gonna be 600, and when you pay that one, pay. Okay, so now it's about time to retire this notes payable, but since their fiscal year ends on September and now they are paying in next year January, so it means October, November, and December has passed as well, right? So we have accumulated, we have interest which is 600, that is already payable, and the amount of notes payable that is 8,000, and also these extra 3 months, right? So the extra 3 months interest rate would be 8,000 multiplied by 10%. Answer is 800. So we use the find out the extra interest that we have to pay for more 3 months. You divide it with 12, multiply with 3. Answer is 200, right? Just write it down, 200. So that is the total amount. So these we already included in our fiscal year. Fiscal year end is in September. Only thing that we have to include it here, this extra 200. So entry would be when you pay back, so liability decreases, liability decrease means debit, so notes payable 8,000, and then the interest payable that we created in our previous slide, so it's time to pay that one, and then the entry would be interest payable 600, right? And then the extra, this 200, that is with current year, it is under current year fiscal year, that is previous fiscal year payments that we create liability, but we are now paying this one, so entry would be interest expense, and now cash that we pay extra 200 plus this is payable and this is also payable, so total amount when you add it, this is 8,800 here, right? If you don't understand this complete example, please do write me in our WeChat group. We can talk about that in our Zoom meeting as well.